All right. Well, as I mentioned earlier, I think one of the things that is unique about the training that Ingram and I have done in NABD is that he provided an operating perspective and I provided a financial perspective. And I've encouraged operators for the last 20 years to not just look at your business from an operating perspective, but also from a financial perspective, because both are equally important. So today, I'm going to give you my financial perspective on what's going on in the industry, and I'm going to tell you what that's going to include. First of all, I'm going to talk about the market in general, changes and trends that have taken place, and where the best profit opportunities are. But in order to take advantage of those opportunities, you're going to need capital. So I'm going to show you where the capital is coming from, who are the major capital providers, and how can you attract that capital to your business. I'm also going to talk about things to avoid when prospecting for capital, deal killers. I work with 32 financial institutions that provide capital to this industry, so I can share what we've learned with you today. I've done some new metrics and performance benchmarks for the first half of the year, and I want to show you the changes that have taken place in the industry during the first 6 months versus what we saw in 2018. And then I'm going to conclude with a proposed blueprint for success in Buy Here, Pay Here. And the hope is that you'll consider those things as you participate in this conference, and you'll find solutions to these things here at this conference and take them back and implement it into your own business. So let's begin and talk about subprime market changes and trends, because it kind of sets the table for some of the other things that we're going to talk about. And when we talk about subprime, I'm going to where I use experience data, which I will in parts of the presentation along with some of my own and others. When we talk about subprime, we're talking about customers that have a bureau score between 501 and 600, as illustrated in the black up there, and then deep subprime is 500 to 300. And it used to be that Buy Here, Pay Here focused on primarily the deep subprime, but what we've seen is that the whole subprime industry has kind of come together here over the last few years with all the competition. How big is the marketplace? Let's start there. Well, in the second quarter, Experian tells us that total open accounts receivable for automotive loans was $1,197 billion. That makes it the second largest consumer credit market, with only student loans being larger than auto receivables. And we also see that banks are providing about a third of the financing for the automotive industry, and we'll talk more about that here in just a minute. As we look at this slide, you'll see, if you look over on the far side of the screen to my right, you'll see that Buy Here, Pay Here comprises about 7% of the total outstanding receivables. So let me do the math for you. That's about an $80 billion outstanding receivable. So we're looking at about $80 billion in the Buy Here, Pay Here space. What's important, though, is you can see banks, again, providing about a third of the capital to the used car industry, which is in the lower side of the screen. But credit unions have become very aggressive in financing automotive receivables, and particularly in the used area. So credit unions have really increased their share of the marketplace. So what's fueled all this growth over the last few years, and where has there been a shift in the market? Well, Bloomberg said it best when they said lenders took chances on consumers with lower FICO scores after the recession, partially on the notion that borrowers prioritize car payments ahead of other expenses. Finance companies started to tighten their standards more than a year ago, and that was in April of 18. So starting in the second half of 2017 and on, a big shift took place. Wall Street, which had been doing automotive bond securitizations, switched their emphasis from deep subprime and subprime loans that were bundled into securitization pools more to near prime and prime. And that's had a big effect on the amount of capital that's flowed into the marketplace. And as a result of that, I think because a lot of those securitizations have not performed the way that they were promised, we've seen a general credit tightening in the marketplace, and that's still true today. We're seeing capital sources being much more cautious and require a lot more in terms of making and extending credit. Certain companies have sacrificed controls and dealer oversight for the sake of growth. And that was said by Amy Martin of S&P. And I would just take the word may out of that statement, because clearly a lot of cheap money flowed into the marketplace, and many of the recipients couldn't get it out fast enough. So they were underwriting customers with no credit and competing directly with the buy here, pay here industry to gain market share. But as I mentioned, subprime losses have increased to pre-recession levels up to a year ago, and that's requiring these finance sources to tighten up considerably and require a lot more from the subprime customer. This next slide shows, I think, that even though subprime has decreased in terms of its total size of the marketplace, I'm going to show you that there's still a lot of customers out there and a great opportunity. And it should be noted that about 33% of the of the used car originations in the second quarter were subprime or deep subprime. So there's still plenty of market opportunities out there. And let me show you how important that is to all of you. If you look at this slide, you'll see that subprime and deep subprime customers are our primary customers as independent auto operators. So we're relying on those, and 47% of all used vehicle sales in the second quarter by independents were either subprime or deep subprime. And I think what's interesting is, and the New York Federal Reserve said this in August, that within the total of the second quarter, originations for customers with credit scores below 620 rose by 1.6% from a year ago. So while we're not seeing that securitization money coming in, we are seeing the independents getting back into the market and regaining market share, and that spells a great opportunity for all of you. Now, what's happening as well is that we're seeing that the loan amounts for both new and used are increasing significantly. And if you look at this next slide, you'll see, and move over all the way to the far side of the screen, and subprime in the top column, you'll see that with amongst all dealers, that would be franchise new and franchise used, that the average loan was almost $15,000. Almost $15,000, $14,877. But across all credit categories, the size of the amount financed has increased. Now, I think what's important, though, is that you know that the average car loan for both new and used in the second quarter was more than $32,000 for new cars and about $20,000 for used cars. So there's still a very big gap between the average new car and the used car costs or prices, excuse me. And what's happened as a result of the size of these loans increasing is that the terms have been stretched out. And to give you an idea, if you look at this next slide, the subprime, deep subprime loans amongst all dealers, both new and used, was over 57 months, Now, that may not be the model that you're following, and that would be a good thing, as I'll show you here in a minute, but the terms have just keep stretching out in the used industry, much like they have in the new industry. But I'm not a believer, and I don't think you are as well, that longer is better, because I took the benchmarks that I've done for the last 20 years, And in 2018, I'm comparing that against the data that you just saw from Experian, and you're going to see some important differences. The independents which we surveyed had an average amount financed of $11,768, which is over $3,000 less than the number that I just gave you in the deep subprime. And instead of a used term of over 57 months, it was 43 months last year. That's over a year shorter than what we saw with the Experian data. Monthly payments were $410 on average in the Experian data, and in the benchmarks last year with the independents we surveyed, they averaged about $390. That's almost $20 a month less, and the average finance rates were approximately the same, 20.76% for Experian and 20.30% for the independents. The point that I'm making here is that the independents did not believe that longer terms and the higher amount financed and newer vehicles or late model used vehicles fit well with the subprime or deep subprime customers that we're serving. And as a result, they did not necessarily follow that business model, and good thing, because those securitizations haven't worked out using that business model. Now, if we look at where the opportunity is today, new car sales are slowing nationally as prices have skyrocketed in recent years. This has been driven by consumer preferences for more SUVs and trucks. If you've priced what's going on in the SUV and truck market, you'll know that it's $60,000, $70,000 to buy a new SUV or truck. And very simply, that's creating a shift to the used vehicle market, even amongst the better credit quality customers. So not only are we going to see more subprime customers come into the space, we're going to see some better quality customers switch over to used as well. And obviously the price of new vehicles today have been driven up by infotainment features, safety technology, the drive to create more mileage and fuel efficiencies, and that's going to continue. So the used market's going to continue to grow and prosper. Payments continue to increase with used reaching record highs. I just showed you that the average for the deep subprime was $410 a month, but I think the important thing here is I'd like you to go back and compare that with what your average monthly payment is, because as we analyze portfolios, we see dealers just not keeping pace with inflation. If you are averaging $70 a week or $75 a week, I think you're on the road to an economically unviable business model, because the cost of doing business, the cost of vehicles, the cost of compliance, everything has gone up. So one of the tips I'll give you is go back and look at what your average monthly payment is, and work on increasing that. And the way to do that is by asking for it. They don't put the beer back when they go to the store if it's $1 more, and they don't buy less lottery tickets, so you're going to have to ask them for a little bit more when they're buying your vehicles. With new vehicles averaging nearly $37,000 according to Kelley Blue Book, monthly payments are just simply out of reach of many of the buyers. That was in the Houston Chronicle in March of 2019. And Jonathan Smoke, who's chief economist for Cox, said that the pool of people who can afford to buy a new vehicle is being reduced by higher prices and affordability concerns. New vehicle payments have become a big hurdle, driving people into used cars. And while the average payment is around $410, $414, that's increased at a much slower pace than the increase in new car payments. So clearly, the used vehicle is much more affordable to the average American today. And interest rates, while we've seen a decline in short-term rates, new vehicle rates are over 66% and continue to increase across all risk segments, which has also driven up new car payments. Interest rates on new vehicles averaged 6.4% in March of 2019, which is the highest in a decade. So let me summarize all this. What does this all mean to the new car dealers? Let's put all this in perspective by looking at what that means in dollars and cents. at the end of February, there was a total of 4 million new vehicles in U.S. stock. In terms of dollars, that's about $140 billion in new car inventory. And while incentives have whittled that down a little bit, we still see a huge amount of new car inventory out there, signifying that there's a great opportunity for you as an independent to capitalize on regrowing market share. I said earlier that capital is needed for growth. Well, who are the capital providers? Where's the money? You know, show me the money. Where are the capital providers today? Well, here's a list. I'm going to show you the top 20 capital providers, and this is the first screen. And you can see that Ally is the largest capital provider in the industry, providing both floor plans and financing to the captives franchise dealers. But you'll see as I go through this list that it's a combination of a number of resources: banks, unregulated financial institutions, credit unions, USAA Federal Savings Bank. And if you'd like to get a copy of this list, it appeared in Subprime Auto Finance News in April of 2019. So there's no secret about who the capital providers are. And by the way, we got a financing fair where some of them are here with us today, so you'll have an opportunity later this afternoon to go visit with them and see if they're the right partner for your operation. But let's say for a minute that you're not doing business with any of those. Well, what do you do? Where do you go to find the capital you need? Well, the first thing you have to know is, are you looking for working capital, or are you looking to have outside third-party financing? Maybe you've integrated retail into your business. So I think if you look at this next slide, the primary working capital providers that you find, regional banks, unregulated financial institutions, floor planners, contract purchasers, and payment streamers all are a source of working capital for you. So if you're not doing business with that top 20 that I just said, there's plenty of opportunities in this area. If you don't know who those are, come see me during the conference. I'll be happy to try to help you find the right capital partner. On an indirect lender basis, probably most of you wouldn't be involved in securitizations because those are generally the size of 100 million or more, and so you'd have to have a very high volume of transactions and a big receivables portfolio to securitize. But we do have regional banks, we have local finance companies, we've got credit unions that I mentioned, and then we also have private investors. So there's plenty of other opportunities other than the top 20, but you have to find out not only who the financial partners are, but what's the right one for your business. Now, there's some things that you have to avoid when you're prospecting for capital. I think there's 10 deal killers, and I'd like to share these with you. Number one is to say that you have an all-new management team. Changing your management structure is not what a capital provider wants to hear. Clearly, they're looking for your track record, your expertise, and when you're making wholesale changes to your management team, they question whether that's going to be a good thing. Number two is don't ask them how quickly they can wire the money. Clearly, they're looking at you to be a good financial manager and a good financial partner. So if you're looking to borrow money from someone so you can pay tomorrow's bills or today's bills, that's not what they want to hear. Number three, and I hear this from some operators, to think that you're compliant because you got the forms from your DMS provider without a compliance management system. Just because you've gotten the right forms from your DMS provider doesn't mean that that's what you're doing in your business. You have to walk the walk as well as talk the talk. Number four, having vehicle sales data but no portfolio performance metrics. And I'm going to talk about what metrics you need, but just telling them how many vehicles you sold last month is not going to get the job done. They're not impressed by that. They're impressed by you keeping them sold, and that's what metrics will tell you. Number five, demanding a higher advance rate. You have to learn to live with less. You have to have more equity in your business. You have to operate more efficiently. How do you do that? Well, one of the ways is go into the exhibit hall during this show and see all the great new technology that we have that you can implement into your business and work more efficiently. So clearly the exhibit hall will have a lot of the answers, but learning to require more, a higher advance rate is not going to happen. It's just not going to happen today. So you're going to have to learn to live with a little bit less. Saying that you're about to change DMS systems. They don't want to hear that because they want to monitor your data, and if you're making a change in your systems, they'll want you to have that behind you to be able to provide the reporting that they're going to need. Number 7, saying you don't have any financial statements, you just got tax returns. That's not good enough. You need to have good financial reporting information and to be able to show your profitability and your financial performance over the last few years. Not having written procedures for underwriting and collections because you think you're too small. I know that you may have a limited number of people in your operation and you don't think you need underwriting and collections, but you do. You need to show them what your procedures are, you need to show them what you expect, and then you need to have a system where you monitor to make sure that those procedures are being followed. Making significant changes in your business model frequently. It's important that you know what's going on in the industry and you tweak your business model from time to time, but making wholesale changes, making major changes is not something that they're comfortable with because it skews all of your performance metrics. And finally, deferring bad debt write-offs. Clearly, bad debts are not like a bottle of wine. They don't get better with age. So you need to take those losses as they come up, get them behind you. That way you can see the trends and understand what's going on in your business. Your business model is extremely important. That is going to tell you how much capital you're going to need, and it's important to your capital provider to make sure that your business model is cash efficient and is operating profitably. And in order to monitor that, they want to have portfolio performance metrics. Now, it's not a crime if you don't have those metrics today, but it is a crime if you don't understand what those are and why you need those. So I suggest that you don't leave this show without understanding what a default rate is, what a static pool loss rate is, and what loss to liquidation rates, or CRR, is all about. If you don't, please come by and see me in the exhibit hall. I'll be happy to show you, but even if you're not able to do that, on my Subprime Analytics website are 2 videos which explain it all. It's all free. You can go on there and see examples of it. Why is this important? Because we've got a new accounting standard that you're going to have to implement, and the basis for applying that accounting standard here in the future is to develop metrics. So it's going to be very important that in your financial reporting, you're going to have to use this information to set up credit losses, and you need to get out in front of this thing. I know we're going to talk about that a little bit more as we talk about compliance hotspots. So metrics is something that you really need to consider. So when is the best time to go out and get capital? And here's the answer. When you absolutely, positively don't need to use it today. The answer is you need to be proactive, you need to develop relationships, it's a partnership, and you need to start that partnership now by getting to know them and vice versa, and not wait until you're in dire needs of drawing down money from a line of credit or some other capital source to be able to do it. Another thing that I think is very important is to understand how your performance and how your business model compares with your peers. And one of the things that you should definitely get is that the NIADA has just come out with a new used car industry report. It just came out a week ago, and all of the NIADA members have been mailed a copy of this as part of your membership. But if you're not yet a member, I want to encourage you to join, but you can also purchase a copy of this. Why is it important? Because it has a tremendous amount of information about all segments of the industry, both retail and buy here, pay here. And I think what's important for you to understand is that if your business model differs significantly from the benchmarks that are in this book, you better have a good explanation why. You better be able to explain why your markup is different, why your interest rate is different. It's extremely important. There's a lot of regulatory activity right now, and I think it's important for you to understand how you compare with your peers, because you may be asked to do that. So how do you compare with your industry peers? That's important to know from a performance standpoint. So here's a few things that we've learned from the benchmarks both in 2018 and now the first half of 2019. First of all, shorter is better than longer. And as you can see by this first slide, in 2015, the average independent term was about 42 months, and at mid-year it was 44 months. So the industry is not getting any shorter. We've continued to stretch out the term, and I suggest to you that that's something that you want to reconsider going forward. We found that the best performance, the highest return on your portfolio, and the best performance is coming from shorter contracts, generally less than 40 months and closer to 36 months if you don't have a lot of add-ons. So clearly, look at your term, because it does make a big difference. If we look at the mid-year performance metrics that are on this slide, I won't go through all of them, but I will tell you that in general, the default rates and the gross dollar loss rate and the average net dollar loss rate have all increased. But the thing that I want to focus on is the change that's taken place in the first half of the year. We're seeing average recoveries jump up a little bit, up about 2%, and the highest point after origination of defaults is now the 20th month. That's shortened a little bit. And what I'm saying here is that operators are being quicker to decide if a customer is not paying to go recover the vehicle. With capital being a little bit tighter, it's important for them to get the vehicle back before it's destroyed. And as a result, we're seeing that having a positive effect on recovery. So when you go back, look at your collection department, and if your customers aren't paying you, you've got to size up what the best step is. Certainly you want them to pay, and you want to keep them in the vehicle if you can, but if they don't pay, no one should be driving for free. And if we look at what the average recoveries are, we'll see that in what I've just explained has only brought us to an average recovery value about equal with 2015. So our recoveries over the last 4 years or 4.5 years have been very flat. So you have to do a good job as a collector is to figure out when to hold them and when to fold them. As far as repayments go, that's another area that we're going to have to work on. You can see here that, that the average payment in 2015 was $89 a week, and now it's $91. Well, that's only a $2 increase, and even in a period where we've had virtually no inflation, we have had a lot of cost increases, as I'm sure you can see in your own business. And you have to go back and you have to increase the amount of payment that you're getting from your customers in order to have the cash flow that you need to be successful. The next thing is down payments. It all starts with a down payment. Deferred down payments are working for some operators. If you're not using them, you should consider it. But we are very slowly working our average down payment up. It was just under $1,000, and it was $784 in 2015, hit a low of 2016 of $714. And the best way to get more of a down payment is to ask for it. And clearly, you've got to go back and do that, because that's how it all starts, and you've got to get into as strong a cash position and the customer have as much equity in that vehicle when they start off today. So make sure you look at your down payments when you get back. The effect is that with higher down payments and higher repayments, you're able to control the amount financed and keep us from stretching out the term. So that's another thing to look at, is that if you implement the two things we've just talked about, you're going to be able to keep your average amount financed. And finally, is your business model cash efficient? What I mean by that is, what is your cash in deal? That's the measure of risk in your business. How much money are you putting on the street? What's the difference between your vehicle cost and your average down payment? And again, I think it's going to control how much capital you need and what your cash flow looks like. So take a hard look at your business model. Not only is it making a profit in your financial statements, but is it cash efficient and what's your cash in deal? So those are all things that we've learned from the last 18 months. Now, I mentioned earlier that a blueprint for success in buy here, pay here business. In 2006, I created this blueprint, and I'd ask you to decide for yourself how much applies today. And if you do believe it does apply, I ask you to find solutions to these things and think about these things as we go through the rest of the conference. The first one is you have to estimate your capital requirements. You have to estimate your costs and expenses, and you have to be able to predict your bad debts. That's where those metrics become so important. You have to know what your cash flow is going to look like and what your capital requirements are going to look like. And I've never seen anybody get into trouble from having too much capital, but I sure see a lot of problems when they don't. So clearly you have to have a good estimate of your capital, the capital requirements that you're going to have. Number two, understand the economics of your own business model. If you just look at your financial statements, and I prepared them for a number of years, that doesn't really tell the whole story, because it's the cash in deal, it's the cash flow in your business that's so important. And we see dealers today, instead of borrowing more money, deleveraging, and actually having more cash in their business. And that's something to really consider. Successful operators find an optimum size for their business and measure or balance their risk and the return. And I'd ask you to do the same things. Not everybody needs to have $20 million in debt or a $100 million portfolio. Just have good contracts and find a size of operations that you're comfortable with. Number three, monitor your cash flow, because it's the fuel that drives your buy here, pay here engine. It's possible for a dealer to sell himself into financial trouble in the buy here, pay here business. I think it's very important for you to monitor your cash flow and to make sure that you're not selling yourself out of business. Right here in Chicago, one of the largest buy here, pay here operators in the country recently had to declare bankruptcy because they were trying to grow too quickly, had a very uneconomic business model, and it caught up with them. So I'd ask you to go back and really look hard at how cash efficient your business model is and monitor it very carefully. Number four, you should control costs and expenses, minimize your taxes with a proper organizational structure. If you don't have a related finance company, you don't know what one is, you should certainly look into it, because typically it's one of the largest deductions in your tax return. If your portfolio is $500,000 or greater and growing, you definitely should look at a related finance company. Yes, we had a change in the tax laws at the end of 2017, and it looked like maybe you could use the cash method of accounting. Well, if you're a buy here, pay here operator and have installment contracts, you cannot use the cash method of accounting. So for those of you who have a related finance company or don't have a related finance company, it's still important that you utilize it because it does generate some significant tax efficiencies. Number five, measure the success not by how big you grow, but rather on how much you owe. Again, having equity and financial flexibility, deleveraging is something that maybe you have to consider rather than taking on more debt. Relying on borrowed money is living on borrowed time. So again, we have to have the flexibility today because nobody knows what's going to happen tomorrow. Number six, learn from your losses through portfolio analysis of your bad debts. You know, there's an old saying that says everyone makes mistakes, but fools repeat them. So learn from your bad debts so you don't repeat the mistakes that have caused losses in the past. Look hard at what caused them. Number seven, develop a consistent underwriting policies and practices. Inspect what you expect, to ascertain whether your underwriting policies are really being followed. And I know we're going to have some sessions on that here. So changes in your underwriting make it difficult to predict portfolio performance and capital requirements. Change in buy here, pay here, particularly big change, is often not good. Number 8, don't be afraid to sell some notes to maintain liquidity. We have contract purchasers here, and I know some of you are against selling contracts. Keep an open mind to that. Maybe it's a good thing. If you have a rose garden, you have to prune the hedges once in a while. If you're a long-distance runner, you have to take a drink along the way. So clearly, look at whether you need to augment your liquidity by selling some contracts and use that capital to replace them with better contracts. Don't be dependent on sales of your contracts, though, to fund your working capital requirements. You can sell yourself out of business by selling your contracts as well, so understand what the cash flow impact is going to be. Number 9, monitor legal and regulatory developments to avoid making fatal mistakes. Clearly, compliance has changed, but it's not gone away, and it's important that you understand the rules and that you follow them, and dealer education is the key to doing that. This afternoon, we're going to have a session on compliance hotspots. We're going to share with you some of the more important things that you need to know. Number 10 is your most important assets are not recorded on your balance sheet. Repeat customers and key employees are vital, so don't overlook them. They carry you through good times and bad times. So your employees and your customers are both important. The key to keeping good customers: treat them like you'd like to be treated yourself and do the right things. And don't overlook the contributions that your employees are making to your success. And finally, get your financial reporting aligned with the industry benchmarks. Get a copy of those benchmarks while you're here. Come by my booth. I'll be happy to give you the mid-year performance metrics. Compare those against your own business. And if you can't compare, clearly you need to go back and arrange your information and get your system to be able to generate information so you can see where you stand. It's important for your own performance, but it's also important from a compliance standpoint. So thank you very much for allowing me to share this thinking with you. I'm here to help you over the next 3 days. I want every one of you to be more successful. I have tremendous respect for you. You're a vital source of transportation to this country, and without buy here, pay here, millions and millions of Americans are not going to be able to get to their jobs or work. So some of the best business people I've ever met are in this industry. So I just wish you a great deal of success for the rest of this year in 2020. I want to help you any way I can, and God bless every one of you. Thank you very much.